Welcome back to the Layman Investor channel, where we talk about all things financial literacy and side hustles. Today, we're gonna go more into the financial literacy side. We're gonna build off of what we did last week. Last week, I showed you how to open up a brokerage account. I did it through E-Trade, but the procedure is basically the same across all different brokerage accounts. If you haven't checked out the video, click somewhere over here and you'll find that tutorial, because today's tutorial is gonna build off of that. Now that you know how to open up a brokerage account, link your bank accounts, even automate some of your investing, I'm gonna show you exactly what type of funds to consider having. Now, I'm not a financial advisor, so I can't tell you exactly what to buy, and I can't tell you any individual stocks to buy, because I don't buy individual stocks, I buy index funds. So today, I'm gonna show you what index funds to consider, what to consider when buying them. I'll also share my portfolio with you that I have through Acorns, just to give you a rough idea of what I'm doing and why I'm doing it. Also, let's talk about index funds. First, before we start buying index funds, we should probably know what index funds are. Now, if you want to know like in-depth, nuanced information about index funds, I highly recommend you read this book, The Little Book of Common Sense Investing by John Bogle. This is the go-to book. This is the best book on index funds. In fact, he's the guy who created them. It's for the Main Street investor. So, what are index funds? Index funds are a type of mutual fund. What is a mutual fund? A mutual fund is a fund. What does that mean? That means it's a collection of people's money. I put in money, you put in money, everybody else puts in money to this fund, and it's managed by a manager who went to school to manage money, invest money into the stock market, beat the market, so on and so on and so forth. And he takes our money, or she takes our money, invests it into the market, builds a portfolio, promises to beat the market and return us profits. That's what a mutual fund is. Now, you have two types of mutual funds. You have ones that are actively managed, and then you have ones that are passively managed. Yes. Now, what's the difference? Well, it's in the management style. Actively managed mutual funds are exactly what they sound like. They're actively managed. That means the manager is going to be actively involved in buying and selling stocks or bonds or other assets using our money, actively buying and selling, trying to position this portfolio that he has constructed for his investors in such a way that it beats the market. Here's the crazy thing. Most of these fund managers, again, taken from the book, most of these fund managers can't actually do what they promise, which is beat the market. But they will gladly try with our money. So they will constantly buy and sell, buy and sell, buy and sell. This racks up fees. Buying and selling is not free, just so you know. There are costs, there are transaction costs. They're gonna take those costs and pass it on to us, the investors. So that means we have to eat that cost. There's also marketing fees, because actively managed mutual funds need to get more investors. That's another fee that gets passed on to us. Oh, and also when they buy and sell, and they have profits in some ways, those are short-term capital gains. So they have to pay tax on that. That gets passed on to us. So there's a slew of fees when you invest with an actively managed fund. And the fact that most of them can't beat the market or do what they promise, it becomes quite a predicament and a problematic investment for us, the investors. Now, I know what people are gonna say, ARK bro, Kathy Woods. Yeah, sure. You can find certain actively managed funds that are actually quite good. Are they good for the next 20, 40, 50 years? We'll see. Do you wanna spend the time trying to find those? Fine, go ahead. That means you will have less time trying to spend time with your family, less time doing the things you want to do. But if you want to play that game, play it. I'm not saying one is better than the other, or one is good or versus bad. It's all about self-awareness. Passively managed funds, or index funds, which I just talked about in this book, are basically a type of mutual fund where the fund manager is not trying to beat the market. They're just trying to construct a portfolio that reflects an underlying index. What the fuck does that mean? An index fund is just a fund whose portfolio is tracking and mimicking an index, which is just a collection of companies. So, for example, you have the S&P 500 in America. The S&P 500 is the collection of the top 500. It's an index of the top 500 companies in America. So we're talking Amazon, Facebook, Tesla, Netflix, so on and so forth. Now, that fund manager that's creating a portfolio that tracks the S&P 500 is not trying to beat what the S&P 500 gains in a year. It's just trying to mimic, which means that he's not going to be, or she's not going to be, actively buying and selling. So the costs are less on that standpoint. There's also not much marketing, which is probably why you've never actually heard of index funds, because there is no marketing. So that's less fees. The whole point of an index fund is to simply track the underlying index that it's invested in. And again, this will make more sense when I bring you guys to my computer. Track the growth of the underlying index, reduce the costs, which is why it's passively managed, not actively managed, passively managed. Reduce the costs for the investors so the investors can keep more money. I don't know what I'm doing right now, but keep more money in their bank accounts. Keep more money for themselves because the costs are much less. That's why index funds are a great go-to for the Main Street investor, for the layman investor to invest in. That's why I'm a big proponent of them. Doesn't mean they're risk-free. There are no risk-free investments. There are pros and cons. Again, we can go more in depth into that, into index funds and whatnot. And you can also grab this book, super, super useful. But now that we have a basic understanding of what index funds are, let's jump to the computer and find some index funds that could be potentially useful in the portfolio that we want to build. Oh, and also at the end of the video, I will show you my personal profile, my personal portfolio that I have through the Acorns app. So follow-moi. Welcome to my screen. I've just gone ahead and Googled Vanguard index fund list, and that way you can just click on this link, get a really quick list of top index funds offered by Vanguard. Now, I'm kind of partial to Vanguard because, again, the Little Book of Common Sense Investing, written by John Bogle, he started Vanguard. They're the ones who started index funds. But again, you can get index funds from Fidelity, Schwab, Ishares. A lot of different companies offer index funds, and they're pretty much great. It's just a question of your own personal taste. They all more or less do the same thing. An index fund that tracks the S&P 500 through Vanguard, through Ishares, through Fidelity will essentially give you the same portfolio and same returns. So it's just a question of personal preference. I prefer, because the OGs are Vanguard, so I went with Vanguard just for this tutorial. So you click on this link, you'll find this little Vanguard page. It's gigantic, as you can see. There's so many index funds, and it's like, which one do I choose? Why do I choose it? Where do I go? But basically, let's filter some of this stuff out because we don't need all of them. So let's really just look at equities for now. So US stocks, equities, same thing. And let's make sure the management style is index or passive. You can basically substitute passive for the word index. We don't want the actively managed because, again, like we said before, higher fees. So now let's see the funds that are passively managed, equity funds. And here's what we have. We have 17, still a lot. And it's like, which ones do we choose? I would highly suggest, again, I'm not a financial advisor, so I can't tell you exactly what to do, but I can tell you what I do for myself and my thought process. My thought process is simple. I want to own America, and then I want to own the international economies. So let's focus on America first, right? I would probably choose, forget about all this dividend growth, high dividend, large cap, blah, blah, blah. I would focus on something like the S&P 500, something like this, VFIAX. or something like the total stock market of the United States. So this will give you the S&P 500 plus small cap, mid cap companies. So this will basically give you 100% of American business, something like VTSAX. So let's check it out. Now, usually with Vanguard mutual fund, index funds, there's going to be a minimum investment. If you go to Fidelity, there won't be, from what I've heard. But if you can't afford that minimum deposit, that's not a problem. You can just get the ETF version of that. And in another video, I'll go over the difference between an index fund and an index fund ETF. They're basically the same thing. You get the same portfolio, but an index fund you can buy in and out of at the end of the trading day. With an index fund ETF, it trades like a stock. So you can trade it throughout the trading day, which is, I think, 9 a.m. to 4 p.m. Eastern Standard Time. So a couple of things to look at when you're looking at index funds or index fund ETFs is you want to see what the actual portfolio is made up of, like the top 10 holdings. So again, this is American business. This is basically the S&P 500. So the top 10 holdings, Apple, Microsoft, Amazon, Alphabet is Google, Facebook, Tesla, Johnson & Johnson, Berkshire Hathaway, JP Morgan, Visa. So these are very strong, long-standing companies that are some of the biggest juggernauts of America. And you're buying all of them, you're owning all of them at once by buying into this index fund, the Vanguard Total Stock Market Index Fund, VTSAX. And that's the beauty of an index fund. Instead of buying separate shares, individual shares of each, you just own all of them. You own the whole shebang by buying into shares of this index funds. Now you can also see here the diversification between the industries. So that's another great thing about index funds and index fund ETFs is you automatically get diversity, right? You have a diversification of your portfolio. And another important thing to look at is this number right here, the expense ratio. This is what you will be paying to the fund for their operation. 0.04%, which is basically zero. Now, certain index funds and index fund ETFs have a 0% expense ratio, so it costs you nothing. That means you get to keep basically all of the profits. And again, like we said, we want to avoid the actively managed mutual funds because they have higher fees. So those are a couple of things to look at when you want to decide which kind of index fund you want to buy. I would say focus on getting one that covers you for domestic markets. So domestic as in if you live in the US, that would be domestic, right? And then get something that will cover you for the international markets. And let's go and find something like that right now. I'm going to go back to the filter menu and I'm going to hit international stocks because that's what we want to find now. And I'm going to have an index because again, we want to have a passively managed portfolio. See the funds. And again, there's 11 matching funds. I would say, again, not a financial advisor, but what I personally like is just having one of these, the Total International Stock Index Admiral Share, something of this equivalent. So let's click on that and take a look at the portfolio. And again, look at the expense ratios and stuff like that. So the expense ratio is kind of high. It's 0.11%, which is still not that bad, but I'm sure there are certain cheaper ones. Like if I got an ETF version of that, that might be a little cheaper. I know IXUS, see that's a little cheaper. The ETF version is a little cheaper. So maybe you go with an ETF version. But again, with the ETF version, because you can trade it throughout the day, don't get trigger happy. You still want to have that buy and hold mentality. IXUS is another good one to look at. That's an Ishares International Stock Market Fund, which will basically be the same portfolio as you see here, which is, let's take a look, Tencent, Taiwan Semiconductor, Alibaba, Samsung, Nestle, Roche, ASML, right, Toyota. So there's some big juggernaut companies from all over the world here in Canada, Mexico, Europe, emerging markets, the Pacific. So you see the region allocation, you see what the biggest holdings are, and the expense ratio is not that bad, 0.08%. I think IXUS might be even lower than that. So now we have two funds more or less to maybe think about, or two different regions to think about. domestic or US, and then international, everything else. So we have equities and a shareholding in basically the juggernauts of world business. And I think that's a great place to start. Again, you don't want to have like too many funds because you don't want overlap. You don't want to, you want your dollar to go as far as it can. And you don't want to have an S&P 500 plus a total stock market plus a this, plus a that, plus a that, and have a giant portfolio of index funds. Keep it simple and keep it straightforward and streamlined. So this is another fund or type of fund I would suggest taking a look at, something like this, a total international stock ETF or index fund. The last one you can get and think about is a bond fund. So that's like very, very conservative. That'll give you some level of diversification as well. So now you have a diversification between stocks and bonds. So let's look at a bond fund and find a bond fund. And all you have to do is, again, filter it out. So let's go to US bonds and forget about stocks. And we can do credit quality. Let's do high credit. And then, or actually, let's just highlight everything and then just make sure that it's a passively managed index fund. Here we have 13 matching funds. And I would say keep it super, super simple. And let's see if there's a total bond market fund. So something like this. This will give you all the bonds, right? Again, we're just keeping it super simple. And again, not a financial advisor. So you do want to do your own due diligence. You do want to read that book, The Little Book of Common Sense Investing by John Bogle. Look at the expense ratio. It's pretty low. The bond, let's see what type of bonds are in here. You have U.S. government, you have AAA, AA, A, and BAA. So those are pretty good credit ratings of bonds. They're very, very safe bonds. You have no corporate bonds. You have no international bonds. You have no low credit rating bonds that are high risk. So these are relatively good, safe assets. And if you can't afford that, find the ETF version of it, and you'll see what the ticker symbol is, BND, right? You can type BND into wherever you have your brokerage account. I have it here on E-Trade as an example. You just type that in, and there it is. And now, through whatever brokerage account, if this is you on TD, this is you on Schwab, this is you on Fidelity, you can do it this way. Just buy and then go through the process of that. But here you see expense ratio is a little lower on the ETF version, and you get the same portfolio. And there you go, guys. That's basically those three funds. That's a great start. And then from there, if you want to build, you build. If you want to go use that as a launching pad to then take higher risk and get into individual stocks like whatever, penny stocks, you want to swing trade, you want to get into crypto, whatever it is you want to do, just make sure you have a portfolio that is in index fund or index fund ETFs that is long term, that is going to allow you to buy overall like large sections of American and international business, and that's a great launching pad to start investing from. So there you guys have it. That is my sort of go-to mentality of how to build an index fund portfolio. Focus on US domestic equities, focus on international equities, and then get some conservative ones like bonds and a bond fund. You don't have to do exactly what I did. Obviously, I'm not a financial advisor for like the last time that I said. Those are some considerations. Look at the expense ratios, look at what's actually in the fund, and then decide for yourself whether you want an index fund version or the ETF version. Now, the moment you've been waiting for, my portfolio that I have invested in through Acorns. Acorns is another app through which you can invest money, open up a brokerage, and do your IRAs. It's a robo-advisor, which basically means that you don't get to choose what your portfolio is made up of. They actually have preset portfolios based on different risk profiles, from conservative to aggressive. Because I'm young, I'm hyper aggressive in my brokerage account. My IRA is moderately aggressive. So what my brokerage account looks like is basically what I showed you here. It's gonna be highly aggressive, US equities and international equities. And this is what my portfolio looks like, with ticker symbols So VOOIJHIJR, that's US equities. That gives me the entirety of American business. IXUS gives me international companies. And that's what my brokerage account looks like. On Acorns, I just automatically invest every single month. The 6th of every month, I put money into this portfolio. And then Acorns will divide my money up accordingly to these 4 portfolios. And that's it. That's as simple as it needs to be. That's as easy it needs to be. Make sure you read the Little Book of Common Sense Investing to get the full gamut, the full picture of what index funds are and why they're useful and how they're a great launching pad to start your investing journey. All right, guys, hope you guys like that video. Hope you found it useful, a useful tutorial on how to start constructing your index fund portfolio, what to consider, what kind of funds to look at, and overall a great launching pad to start your investing journey. So if you like that tutorial, click the like button down below, share, comment, subscribe, put the little bell on so that you get notified every time I come out with a video. I'm gonna drop links down below for some great courses on side hustles, because side hustles are really important once you start understanding the infrastructure of building your investing portfolio. Now you gotta fund it with money. So building side hustles is key. As always, I'm available in the comments below. DM me on Instagram, DM me on TikTok, follow me. Just here to serve. Happy investing.